Evening, everybody. I hope everybody is doing well. My name is Hans August, and I'm actually one of the business directors here in New Jersey with our Infinite Company. Uh, Tonight, if you got invited to this presentation, it's most likely because someone wanted to make sure that they shared some excellent wealth building strategies. So this is part of what I call the ultimate wealth building strategy. This is teaching you how to leverage wealth. What that means is that as I've had this conversation with many folks across the United States, one of the things that we've learned is starting early and learning how money works matters, basically. Meaning that as you begin to understand the power of what is possible in the money works game, you begin to realize that there's a way for you to start additionally changing the conversation with everybody. What that means is as you change the conversation with everybody, you begin to realize that there is a strong opportunity to become clear about how to position yourself. So I'm going to try tonight to make sure that you walk away with a tremendous amount of understanding. What we do as an organization is A, financial literacy, B, helping people put solutions in place, and number three, making sure that there's proper ways to leverage wealth. In America, there are three forms of money that everybody should understand. And the three forms of money makes you understand that A, if you are currently at a job where you carry a position as an employee or W-2, part-time, full-time, or salaried, the form of money that you're making is called income. If you happen to be a business owner, 1099, LLC, S Corp, corporation, what that means is that most likely the money that you're making is positioning you to access profits. And that's the form of money that you make. Once your income surpasses the expenses tied to that business, then everything else that you're walking away is called a profit. But tonight I'm going to teach you how to leverage wealth. Wealth is the idea that you learned how to place your income and your profits in strategic wealth building activities. Those wealth building activities is what allows you to create a third form of income. That means money that you don't need to particularly be involved in, but you just got to learn how to strategically grow it. What that means is that I came up with the understanding that as I grew up, the first form of money I got introduced to corporately was as a city banker, and that's how I earned my salary, and that was how I earned income. As I began to understand that there was entrepreneurship available, I started leveraging real estate as a way to create a profit. And in that process, I was able to not only act first as a primary listing agent and a primary buyer agent, helping people kind of understand what their options are when they were interested in purchasing a home. But in addition to that, I realized that there was a process where people can begin to grow the value of their dollars through wealth. So tonight I'm going to share with you guys the ultimate wealth building strategy. I'm going to show you how I've learned to leverage an index universal life in my experience as a real estate professional investor. And what happens is I'm going to give you a quick comparison that says, hey, let me just give you some value points. The value points is to begin to understand that at the end of the day, we want to kind of make sure that strategically you are positioning yourself in your favor. What you really want to begin to realize is that let me give you the pros and cons of building wealth through real estate and potentially learning how to leverage a index universal life insurance policy. And in that position, some of the questions that you want to get answered tonight is what are the challenges of real estate? The other thing that you want to understand is how do you leverage an IUL that potentially offers you a better cash flow solution? Why? In real estate, it's a great strategy, but there are challenges that are tied to it. But ultimately, the reason why somebody got involved in real estate was because there's a cash flow that they can create. I'm going to show you how this actually can complement. I'm not telling you to give up your real estate practice, but maybe it could replace maybe the activity. As I got older, I realized that the chase of finding property and developing it was very valuable in my earlier days. But today, as I understand it, there might be some cases where I can leverage the idea of wealth. Wealth was the idea that I don't need to be 100% involved in it, but I might need to be able to leverage the solutions of cash flow to position itself. Because when I got into real estate, what really happened was I understood that this is how it worked. It worked in the idea that I'm going to purchase some sort of property. As I purchase that property, I'm going to hold on to that property and convert it into a form of a rental income. That rental income, I'm going to generate it as cash flow. And one of the other ways that I could make money doing it was leveraging it in the form of equity or appreciation. But in order for me to do that deal, that transaction, I had to borrow more money from a bank, which means that most people are going to obtain a mortgage or some form of a loan to make sure that they can continue the purchase of that property, just like any traditional American who's buying their first time home. But if you're an investor, there are maybe about four common strategies that people can end up leveraging highly in real estate. There's multiple strategies, but maybe the four most common ways for you to leverage money in real estate is to buy the property and hold it as a rental income or a form of appreciation, or you can identify a problematic property that needs to be fixed. But the reason why you're going to fix it is because you plan to flip it. Flip it means that you plan to sell it to somebody else, but you've improved the original value of the home, roofing, windows, because some buyer who's interested in buying it is going to buy it because it's finished product. But if you own property, you can either use a traditional tenant to rent a home, but one of the other strategies in real estate that has become very common these days is the ability to leverage what they call short-term rental strategies. Those short-term rental strategies can position you to make sure that you have access to cash flow because you're renting it out to somebody who might be a vacationer, someone who has a job assignment, but is being rented out on a daily basis. And then maybe the most fourth common strategy is commercial property. Businesses need places to lease, to run their businesses, and most likely the property owners of those commercial locations will begin to position themselves to make sure that they can rent it out to another business owner. If you have a laundromat, if you got a daycare, generally those places may own the building, but most of the time it's actually being rented out and leased from a cash flow standpoint. In addition to the idea that I learned real estate had value, there was some major challenges that you can begin to encounter in the conversation of managing property. The first thing that you can run into is that maybe to get started with it, there is some initial down payment or capital that you got to provide to that solution, which means that if you're going to grow a real estate portfolio, you have to have access to down payment. So a lot of times, especially as an investor, you're going to need access to down payment dollars. And if you're buying a property for $500,000 and 20% down is the requirement, you need $100,000 of your money or somebody else's money to be leveraged. There are market volatility issues, meaning that if I buy in the right location, it's great. If I run into a challenging location, there's a case that the value of my properties can decline depending on the timing of the market. Back in 2008, people were losing the value of their homes because the market conditions changed. But if that didn't happen to you, there's a good case that you're going to see some sort of tenant challenge. If you have a long-term property, you'll find that the traditional tenant might be great with paying on time, but if they lose their job, they might not be able to continue to paying that lease payment, or there might be some sort of property damage that they're going to experience in the process, or you're going to experience a property damage challenge, whether it's a long-term tenant or a problem that you're going to manage in a short-term world. But those are just realities of how that business can work. And one of the things that I really got my attention was what they call liquidity. Liquidity is the idea that you need access to the money that you put down on the property, or if there's appreciation and you want to borrow against it, the only way you can move money out of a real estate deal is either to sell it or B, borrow money from a bank in the form of what they call a traditional refinancing or the ability to get a line of credit. And as you manage property, you'll find that there's property taxes that you need to address on a regular basis annually, or if not, they can take the property away from you if you don't even do that properly. So I tell people, as you begin to understand the amount of time and the management responsibility,
it's not the worst thing in the world, but there are challenges and risks in managing real estate that you need to be aware of. What got my attention was the idea of a mortgage, which everybody uses in America. It's not illegal, but you need to understand the structure of a mortgage. When you're an investor or you're understanding how money works, you begin to study where is your money going and who is receiving it. You begin to understand how much of it are you really making because you want to run the math. As you understand how mortgage debt is organized where someone's going to pay interest, and most likely that's you, and that money is going to be handed over to a bank. As it gets handed over to a bank, they're the one that's leveraging the rule of compounding interest on you. Doesn't mean it's illegal, but you begin to realize that there might be places that you could have leveraged your dollars, and there would have been other places that you can create more opportunity. So there's something called lost opportunity cost. But the truth behind a mortgage, even if you have an interest rate of at least 5%, what you want to begin to recognize is how does the mortgage actually work? The way that the mortgage really works says, hey, I'm going to borrow from a bank $300,000. I'm going to get an interest rate of 5%. And once they run the math based on a 30-year period, generally that mortgage is going to be estimated at $1,610 if you are borrowing $300,000 at a rate of 5%. But as I did more deals, I began to study what they call the amortization schedule. And this is a calculator that says if I borrow $300,000 from a bank and I have a 30-year mortgage at an interest rate of 5%, if I spent 360 months paying that mortgage down at the rate of $1,610 per month, I would have paid the bank not only the $300,000, but an additional $279,000 in interest. That is money that handed over to the bank legally, and they compounded their dollars where I end up paying them $579,000. Now, most investors might say to me, hey, I don't plan to hold it that long. Well, that doesn't matter because the rules of an amortization schedule says, yes, even if you were holding me for 1 month, the $1,610 payment represents that you're going to pay the bank $1,250 in interest, and you're going to pay only $360 towards your principal. So the math says that 78% of this $1,710 payment that month or the next month is what's going to be paid. So that over a 3-month period, you literally would have only paid $1,000.86 dollars towards their principal, but you would have paid $3,745 in interest. What that meant to me was that if I made $10,000 on a deal, but I held a mortgage for 3 months, it really means that I only made about $6,000. And although you walked away with 10,000, you still profited at $6,000. You start to run the math to begin to understand what's the best way to make money. As I understood how to make money, I understood that there are alternate ways for people to grow their dollars. One of the alternate ways that I ran into was understanding that there's an index universal life strategy that people leverage as a way to alternately build more wealth. All that really means is that people have learned to take what they call a permanent life insurance policy that has a component that's very important to the structure of how that account works. It means that this account has a cash value accumulation amount. And because of that cash value, they will take that value of the dollars growing there and they will put it in certain interest rated stock market performance accounts. And the most common one is called an S&P 500. The S&P 500 is the top 500 companies in America, and it might change one or two at the bottom, but they are how they're going to measure how they're going to pay interest into this account. And once I understood that there was an opportunity to create a tax-free distribution in the form of loans, I realized that the income distribution from that account was just like cash flow in a rental income. And then I started to understand that some of the key benefits of this account was that, hey, I can protect the equity that I've built in the property. I can protect the ability to develop an appreciation, which is more value of the dollar that's going to be paid out into the future, just like an equity position in a house. The best thing that I realized was that there was a strong upside potential, but I was protected against what we call a zero floor strategy. A zero floor strategy basically means that regardless of market conditions, I won't lose the value of the money that I've put into that accumulation account, and I won't lose the value of any interest that I've gained outside of the cost of insurance, because that's how the cost of insurance is funded. But there's this particular IRS code called 7702 that you have to study. What that means is that this code allows you to create what we call a tax advantage when you have this type of contract or account. That means you can create wealth accumulation without you being the active person, because wealth is the idea that you're going to take some of your income or your profits. So if you made profits from a real estate transaction, you could literally open a contract account such as this with the intent to create retirement planning or leveraging the cash in the future under a tax advantage environment or a tax-free environment. As you begin to understand how real estate really works, if you have experience in it, you already know that there's going to be some sort of initial investment that you got to put into it for you to purchase the property. And you're going to realize, if you've never done a real estate before, that you're going to have to borrow money from someone, whether it's a bank or yourself if you have the cash, or any other lender that will give you money on this deal. As you do that, your capital is on the line, so you got to strategically do it right. And the intent, obviously, is to earn cash flow. But in your cash flow position, you realize that there are expenses that you have to manage. Mortgage payment, insurance, taxes are part of anybody's expenses that are typically tied to the property outside of any other maintenance things, but those are the most common ones. Because you have to buy the property in the right place, you got to fight against the idea that value can fluctuate based on where you buy the property. Or you have to be concerned about tenants not paying a mortgage because you really built the property to cover that expense. Now, some people do this extremely well, and other people have to go through certain learning curves, because when a tenant doesn't pay, you have to come out of pocket for whatever mortgage that you're carrying in order to make sure that you don't experience any unnecessary loss in the form of foreclosures or late payments and fees. But you do that well, there's still taxation. Taxation says, hey, you owe the local government or the local municipality taxes. And if you sell, there's taxes there too. So you have to learn the leverage points. But one of the leverage points in real estate is liquidity, but the liquidity events only happen, or the ability to take out your cash or your money, same thing as liquidity, is the ability to understand that the only way you can do that in a real estate transaction is to either sell it, refinance the property, or leverage a line of credit. Those last two pieces are subject to your credit or the value of properties in that area at the time. Now, in America, we've seen a large amount of value increases, so there is appreciation. So in real estate, it can work very well if everything is aligned properly. Now, when I started studying index universal life policies, I began to realize that what if you and I had $100,000 and we can, instead of purchasing a property, which is nothing's wrong with that, we took the same $100,000 and we put it into an index universal life contract or account. I quickly realized that depending on how I strategically flow that money into that account, I didn't need to borrow any money from a bank, which can be a hurdle sometimes in real estate if you have to get. But I can literally sit down with a professional who says, let me show you how to open up a contract or an account. We're going to organize some money, very much like you would put in a real estate transaction. You don't have to borrow any money from the bank, but we're going to strategically put the money in the account so that we can create income distribution or growth or the value of the $100,000. And then if you and I were not in a position where we don't have to worry about market losses and we can guarantee what we call a floor, then we can create what we call tax-free withdrawals from that account. And when I understood that I could borrow my own money and get it in 3 to 4 or 5 days, and I understood that there was an opportunity to grow the value of my cash and create what we call benefit appreciation, which is unfortunate if somebody passes away, that tax-free death benefit goes to the family member as you if you were building anything else. Just like you would need to sell the house, I can teach people how to instantly transfer money. So the key reasons why you want to leverage an IUL is because you can generate wealth. Wealth is the byproduct of your income, your profits making you more money. You can do it under a tax-free environment. You can position yourself not to take any losses, and you can leverage this contract and account just like a real estate deal. You could use the policy loans for investing or personal use because that's what people do. They borrow money from their properties and they mortgage themselves, which is fine because it's legal, and they go do other smart things or they do other things like pay off debt. But if I can create myself a self-financing system, that means I can borrow from my own policy instead of a bank. I can create another passive source of income because I want to convert this cash value either into income distribution or a potential retirement income strategy. Because in America, you need money, you need distribution, you need wealth or profit. So now that I know how to do that, if I'm leveraging real estate, I can understand how to potentially reduce my risk or reduce any version of a risk because that's tied to the problems that might be associated with an account managing real estate. Because in the liquidity, in the ability to not worry about tenants, in the ability to create tax efficiency, because in an IUL account, you can create a tax advantage. But more importantly, I understood that I can create instant wealth transfer. The death benefit or the life insurance policy that's tied to this account will be distributed to my heirs or my beneficiary, and I don't have to have a conversation with a court to do that. In traditional property, that could be the case depending on how you structured it, if you don't understand trust and other things. But for the standard, I told people never not liked real estate. Matter of fact, I loved it. I just realized some of the challenges. But what if you could combine the efforts of these two strategies so you can position yourself for the ultimate? See, money makes you more money. If you know where to place it, your profits make you more profits if you know where to place it. So what if you use an IUL to fund your own real estate investment deals? See, a bank is a group of money that gets available to anyone who decides to borrow it. But what if you created your own bank and you could leverage the cash value instead of obtaining the mortgage that has an interest rate tied being paid to somebody else? And what if you could pay yourself that interest rate? What if we can also create an environment where we can create cash distribution just like rental income, but we can do it tax-free? We can also build alongside the idea of real estate because now you're the bank, or you could leverage the cash in your strategy to buy more property or do smart things with the money, which is make more money, and then you can create legacy. Legacy is the idea that, unfortunately, if you passed away earlier than building out a portfolio, which many people survive and still do that very well, but what if you didn't make it? You would have the death benefit of an IUL and the structure of that account to pay out something tax-free. Here's a case study that I want to share with you before we close out. This was a peer of mine who says, hey, I got about $500,000 available. I understand that there's a situation where we could leverage an IUL versus a real estate strategy. What would that look like for me? I said, well, what we're going to do is we're going to spread the $500,000 over a 5-year period because you're going to leverage the course of time to grow your dollars while you contribute annually to this account. The goal was to say, hey, part of this money is going to go into what we call an accumulation account. That accumulation account will also have what they call a surrender value, which represents how much money you can loan yourself after a year. But in the meantime, if something happens to you while you're building and growing your dollars, based on your age and the value of what you've contributed, we're going to be able to pay your family, your wife, your children, your heirs $2 million tax free. What you want to know about a life insurance policy is that regardless of what money gets sent out to the family, this is a tax free death benefit. And I said, by the time we get to the fifth year, where you're currently age 39, approaching 40, the value of your account would have increased to $27,000 more than what you've contributed in an account due to the component of interest that will be added to this account. With that being said, if you needed to borrow against this account, you could call the account holder, which is the institution. They'll send you $100,000 of your money or $200,000. This represents that you have $534,000 worth of money that could be leveraged in the form of a loan. And the interesting thing is that you could leverage time in your favor because the loan doesn't require an immediate payment schedule like a mortgage. With that being said, as you do your real estate transaction and deals, you could leverage time to replace the money to use it again. And let's say you just continue to grow only because you like the idea. So he said, show me how I cash flow. I said, well, depending on the age and the timing that make sense. If you were age 54, which is what he requested, at the age of 54, we can guarantee $106,000 and $666 per year tax-free. What that means is this money that's being distributed to you annually based on the value of 1.2 million at the time that you decided to capture this money tax-free, we would pay that out on an annual basis or monthly basis tax-free. As I begin to understand that, I realized that there was a large amount of opportunity in addition to additional benefits that are available in this account called living benefits and other reasons that you could leverage money outside of death, or the reality is to create an institution of funding for yourself to position more dollars. So when I have these conversations with everybody, what I realize is that everybody has the ability to consider an index universal life as a wealth alternative tool. But commonly, we've talked to real estate investors who are looking to create more risk-free liquidity. We're talking to business owners who want to create more tax-free cash flow. Because maybe as a business owner, you would love the idea of doing real estate, but based on the time and the management and responsibilities of your business, we can help you position a solution as a wealth building alternative. For you guys who are high income earners, we can create certain tax efficiencies with wealth building. And for those that are retirement saving, maybe you're looking for a safer alternative outside of certain risk challenges that could be tied to any strategy to position your dollars in your favor. So as I begin to have these conversations, what we recommend is if you've been invited to this call, I'm going to recommend that you get back to the individual who's invited you to this call so that you can set up a time to do what we call a cash flow strategy. What we do is we sit down with each individual. There's no cost to this session. The institutions that we work with, the education retirement program that we work with, covers the reality of us sitting down with you with the intent for us to sit down and have a true session without any obligations, with the intent to make sure that we can discuss your financial goals and strategically come up with a plan that will either help you build the ultimate wealth building strategy or a strategy that can fund the business principles that you have or the real estate strategies, or just teaching your family how to build wealth, leveraging an account like this. I hope you guys have enjoyed this conversation tonight with the intent. We host this call every Thursday night with the intent to do workshop for free financial literacy, but we teach people how to put true solutions in place. So if you'd like to learn how to build wealth and have a better conversation about some of your financial goals, get back to the individual that's invited you to this call. Thank you for taking the time. and we will see you next Thursday so that we can get better understanding. And we appreciate all of you guys taking the time to attend. I don't know if there's any questions from anybody tonight before we wrap up, but good to see you, Mr. Ridley. Miss Sully,
You
appreciate
too,
your
Mr.
time.
Hans.
All right, sir. So you guys have a great evening. I'm gonna get a little rest, but Mr. George Ridley, I will give you a call because I saw I missed there before. We'll talk shortly, sir. All right, take it easy.
Okay. All right. Thank you, sir.
Thank
All
you.
right.
Same to
All right,
you.
all right, Miss Sully. Thank you, Mr. Jones. Thank